Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week we take a look at Chuck Akre, who is one of the greatest investors of our generation. His thoughts are especially interesting on the idea of compounding returns. Chuck is one of the best modern day investors there is, and he's been outperforming the market with about a 17 to 18% compounded return since 2009. He's a very concentrated long-term investor, and the businesses he is searching for he calls compounding machines. Let's look at how Chuck Akre finds and defines these compounding machines. He says, average return in common stocks for nearly 100 years in this country is around 10%. Whether it's 9% or 11% is of no consequence to us, and that's dividends reinvested. That's total return, absolutely, and so in our case, we look for it to be able to return above average returns, and we've done so for a very long time. And then depending on which vehicle we're talking about, it's a different level, but substantially above that average return. This explains the average return of the market is about 10%. So realistically, this should be our target of what to beat if we are stock pickers and investors. If you aren't willing to or don't think you can achieve better than a 10% return per year, then you're better off just putting all of your money into an index fund and accepting that over a very long time you can reinvest your dividends and get about 10% overall return. Chuck Akre is well and truly outperforming that 10% benchmark. He's achieved about an 18% return since 2009, and in that period, the S&P 500 returned about 14%. He has done that by finding these compounding machines in a concentrated portfolio, and we'll dive into a little bit more about how he's finding these companies and what those companies look like. Chuck Akre was asked, why don't you favor dividends as much as many of the other great investors I talk to? This explains why he doesn't want these companies to be paying a dividend. The reason is quite simple. With the free cash flow that each business generates, there's certain ways they can allocate that capital. The best way, he thinks, and I would agree, is that you reinvest the capital back into the business or spend that capital to acquire other businesses and achieve great returns on those investments. By reinvesting that capital back into the business like that, it's able to compound over time. If you just pay that capital out as a dividend straight out to all of your shareholders, that money is not compounding anymore. That's not to say that there aren't great businesses that are paying dividends, but if we really want to compound our money, the most effective way, we want that capital reinvested back into the company with high returns. Chuck Akre certainly agrees that if you want those companies to be able to reinvest that capital continuously at high rates into the future, sustainable returns on invested capital moving out into the future is required for a very long period of time. He says that there are three components he looks for in a great business. Number one, the first is we spend a lot of time trying to understand what's causing this above average return to occur. Is it getting better or worse? Number two, the second thing that we look for are the people who run the business, and not only do we want to have great business managers, but we want to see to it that they treat public shareholders as partners even if they don't know them. And then lastly, number three, we look to see if there's a great history of reinvestment of the free cash flow, as well as a significant opportunity to reinvest free cash flow and earn above average rates of return. That is how Chuck Akre is looking for these businesses that compound better than the S&P 500. He calls it a three-legged stool. Those three things that he's looking for in a business, the absolute most important thing is a competitive advantage or moat, a solid management team that treats their shareholders like owners of the business, and a business that can reinvest capital and have successfully in the past and can continue to do that successfully in the future. That's as simple as investing can get. If you're looking for those three things and you can successfully identify them, you're going to do very well in investing. He was also asked about his view and what he looks for in underlying business. He said, well, American businesses probably have single-digit net margins on average, and the returns on equity returns in the owner's capital, as I suggested, are probably in the low things. So if we find a business, as we're looking around, that has returns which are significantly greater than that causes us to get curious about why is that occurring. And so the simple reasons would be that they have parents or they have the absence of competition for one reason or another. That's the moat, right? That's the moat. The frequent phrase that's used, and sometimes in a business we say, well, we don't know precisely why they're able to do it. This is what we think. The first thing to take note of is that he's looking for a business with above average net income margin. Now, looking at his portfolio, he's not looking for these really excessively high margins like some companies have, although two of his biggest positions are in MasterCard and Visa. Those two companies have some of the best margins in the stock market, so that's definitely something Chuck considers. The other thing he mentioned is this high return on owner's capital, which is another way of saying return on equity, but really, we just need to look for all of those return metrics. The return on assets, the return on equity, the return on investor capital, the return on incremental investor capital. All of these metrics are going to help us to get a guide on how this company is reinvesting back into their business. We want these numbers to be fairly high. He said that we want a company to have a moat or a competitive advantage that can be seen by those high returns on capital numbers. Sometimes we can't exactly pinpoint what that competitive advantage is, and that we may have to just trust management to continue to do this into the future. But of course, we want to the best of our ability, really understand those competitive advantages and whether they're going to be sustainable into the future. Here, Chuck is talking about some of the things he wants to hear management teams saying to their shareholders. The communication that they're putting out, he really wants to see them talking about how they are going to be reinvesting that free cash flow. That's just one way how we can identify the quality of a management team or whether or not they're trying to act in the best interest of their shareholders. But as Chuck said earlier, we really want a management team that treats shareholders like owners of the business, because really, that's what we are as shareholders. Benjamin Graham says, we really want to think of ourselves as the owner of the business. The other thing that Chuck touched on there is that investing can be more of an art than a science. And of course, there's plenty of people that take scientific approach or more so a mathematical approach to investing. Being quaint type investors, and of course you can achieve great returns like that, but Chuck argues that it's better to take that more creative and that more art-based approach to investing, and we have to make some of these judgments like that. It's not all math and numbers and analytics that we can make our decisions on. We also have to get a little bit creative and try to understand the story and the management and all of those things. He believes that return on invested capital or that return on equity number can realistically be a return that we see as investors approximately over the long term. That's assuming that they're not paying out a dividend, of course, because that's going to take away from that return, but if they're reinvesting capital and generating returns at about, say, 20% consistently over the long term. I hope that you enjoyed this week's episode on Chuck Akre. Please consider subscribing to my channel. Also, if you enjoyed this video or you found it helpful in some way, then please remember to leave a like on it. This also really helps my channel grow. So, like this video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.